What lies ahead for the U.S. and global economies? Well, our chief equity strategist and economist, John Blank, hopefully has that answer. John, what do you see the December 22nd GDP report showing?
Well, the GDP report coming for December 22nd will be the final revision of the third quarter. So I don't expect much more than we already know, which is plus 2.9 or 8 for the third quarter, and the market will not care. We do need to get the advanced reading in January for the fourth quarter. That actually is more interesting. And for my call in the fourth quarter, I'm looking around 2.8 to 3%, basically the same thing we saw in the third.
Any surprises, though, in the upcoming report as far as what it's going to show, both expanding and contracting?
Well, I think the real issue will be the housing market, Terry. I have noticed, nationwide housing inventories lately were up at the 9.7 months. And if you break 10, you do get a recession, generally speaking. And that'll be something I'll be looking for.
And from what you've written recently, it seems that in this report, there's something both for the bulls and the bears, correct?
Correct, because the GDP report does consider price inflation, deflation, and that probably will be a welcome evidence for the bulls who are believing it's going down. And, they'd like to see more of that confirming. And I do think, typically at the end of the year, there'll probably be some special elements to the BEA's production, and that tends to provide a year-long look back at 2022. That could also be somewhat interesting.
What's your Fed policy outlook going into 2023?
It's no different than what everybody, the Fed told us yesterday, which we're talking again on December the 15th. They broke up on the 14th, and that is, 5 to 5.25 for the Fed funds rate, 1st of July, middle of the year, hiking in 75 basis points from here. And then, being somewhat January, February of 2024, starting to cut, actually, and moving to, July 1st, 2024 at basically 100 basis points lower than 5 to 5.25, so 4 to 4.25. And that is the look. The Fed's going to hold up, stay up, at least 6 months, if not a year, at 5.25, and then come down.
What about that language they threw in at the end of their meeting yesterday, that there could be more rate hikes in the new year than originally anticipated?
Totally correct. The core PCE, which they like to get a 1% above of, they like a 1%, what's called a real Fed funds rate, which means it's above the core PCE. The core PCE is at 5 right now. So they have to go to 6 if it doesn't come down. And their 5 and 5.25 call means we got to see the core PCE at 4 and 4.25. That is the thing that the Fed is watching, and that can change its dynamic quite dramatically.
How do you compare Fed policy to that of other central banks?
Well, today we saw the BOE, Bank of England, raise 50 basis points just like the Fed, and the ECB pretty much followed suit too. So everybody just waits literally till the day after the Fed and does the same thing.
Has the global economy just begun to cool, or has it been cool for a while?
I think it's actually in sync with the United States, other than China, which has obviously done COVID shutdowns. But Europe growth is, basically better and stronger, just like the U.S. for 2022, and it's down in the 0 to 1% range for 2023.
And as we near the holiday shopping season, if people haven't already gotten into that mode, what's your outlook for the retail sector? How do you think it's going to wrap up the year?
As good as last year. I don't think it'll be any different, and people are just ready to get out, and they simply do not care. And those who are, the housing market's drying up from listings perspective, sales perspective, but 10 years of zero rates, if you locked it in, which is true for 96-7% of people, it's not affecting them at all.
So you don't see the consumer starting to hit the brakes on spending?
No, I do not. I think we have to have the jobs fall apart for that to happen, and they are holding up well.
Okay, major firms located in consumer staples, foreign autos, and the energy sector made it to your highlight list recently. Among them, Coca-Cola, HBC, Yamaha Motor, and DCP Midstream Partners.
Yeah, these are names you don't actually hear a lot about because if you're a U.S. citizen. Coca-Cola, HBC AG is actually the European version of Coca-Cola, and I mean European East and West Europe. Zach's number one rank, style score B for value, B for growth. Like I told you, European consumption is actually holding up. People are drinking Cokes across Europe. That's clearly the case. Keep that in mind that it's a really good time for purchasing of defensive stocks like this in Europe. A good play. Yamaha Motor, of course, this is Japanese. They make and sell motorcycles, auto engines, and transport equipment. Number one ranked stock, A for value, B for growth. Really attractive position. I have to imagine Yamaha Motor is positioning electric motors, much like Cummins in the United States. So, and again, an interesting electrification play that's buried here. DCP Midstream Partners. Midstream, of course, means upstream and downstream. This is in the portfolio of gathering, logistics, marketing, and processing energy. Right, this is basically oil and gas, but not at the drilling level and not at the refining level. Somewhere in the middle. It's based in Denver. I've got an A for value, A for growth, a number one rank. I would probably stay away from this stock given the energy prices have fallen apart. But if you're looking for a dividend play, this thing offers 4.4% annual yields.
Our chief equity strategist and economist, John Blank, updating us on what he sees for the U.S. and global economies. From John and I, here's wishing you a Merry Christmas, Happy Holiday Season, and the best of the new year. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.